How to prepare for pitching a VC? What does venture capital pay attention to? What are the most common mistakes to avoid pitching VC? And what is the current landscape of VC investing in the context of current macroeconomic situation? Following is my conversation with Jan Szumada, an investment analyst at Warsaw Equity Group. Enjoy. Jan, can you distinguish the situation when one should take on a VC partner and when one should not take a VC partner, or it's not necessary to take on a VC partner?
Mm-hmm. Yeah, it's important to say what type of businesses VCs are looking for. So first of all, you have to have a very high ambition because VCs are looking for returns that are sometimes 50x, sometimes 100x per company. So you need to really have very high ambition to develop your business. If you aim to grow by 15% per year, VC is not an appropriate partner for you. To give you an example, typically VC funds are looking for a return for each company, which is equal to the number of companies that they have in the portfolio. So if a VC fund has 10 firms in the portfolio, each company needs to have a potential to return the whole fund. So each company needs to have a potential to grow by 10x. If the fund has 50 companies in the portfolio, each company needs to have a potential to grow by 50x and to return 50x the money. So first of all, yeah, as I said, you have to have really high ambitions for growth. Obviously, you need to have potential for growth. So you need to operate on a market which is large enough. If you are operating in a niche market, you won't be able to achieve this kind of growth that I talked about because simply there will not be enough customers for you. Another thing that is important is pace of growth. So not only the scale that you will achieve, but how fast you will achieve it. VC funds have a limited lifetime. It's typically 10 years. So funds collect money from limited partners, they invest the money, and within 10 years, they return the cash to the investors. It is important because it means for you as a founder that you need to be willing to sell the shares within this time frame. I mean, you have to enable VC funds to make an exit within this time frame, and you need to enable the VC funds to make a fast return during this time period. So the pace of your growth has to be really fast. How fast? I would say that it's quite difficult to get funded if you grow less than 100% per year. Obviously, it depends on the stage of the investment. If you are a more mature company, the pace of the growth can be lower. But in general, I would say that the rule of thumb is you probably should grow by at least 100% year over year. And another point is that you have to be willing to make an exit. Maybe you as a founder, you don't have to sell all of your shares when a VC fund does. For example, when the company goes for a public offering IPO, then you can still have your shares in your company. But what is important is that you have to be aware that VC fund will be motivated to sell their part of the business within a certain time frame to fit within this 10-year window that I mentioned earlier.
So if I'm to keep a business for life, VC financing is probably not the right way to go.
It could be, but it's definitely important to discuss it first before making an investment. And always VC funds talk with you about it. But if your ambition is to have the business forever, then definitely this limits the options for the exit because, for example, strategic buyer wouldn't be that interested in the business.
From what I've read and from what I heard, is that the whole return of a VC fund is based on something between 2 to 10% of the companies invested in.
Yeah, this is correct. This is correct. When you look at the distribution of the returns per company of a typical VC fund, you will see that half of them, roughly, doesn't return the capital that the VC invested in them. A few return about 2x, let's say, and usually there's one or two, we call them fund makers, companies that are responsible for the vast majority of the value of the portfolio.
Suppose I am in a position when my business is growing very fast. Probably I have problems with controlling this growth, which makes me a good candidate for a VC-backed entrepreneur. What should I do, let's say, before I start fundraising? How shall I prepare?
Yeah, maybe let's start with the materials that you need to prepare. I think the most obvious one is pitch deck. It's basically a presentation where you present your business and you send this presentation to VC funds so that they can understand what you're doing, what are you looking for. And I don't really want to get into details of how to prepare the pitch deck, but in general, I would say that there are a few things that every pitch deck has to address. First of them is that you have to show what problem do you want to solve clearly. So you need to demonstrate that there is a real problem that your business is solving. And you have to argument why do you want to solve this problem. Also, it's important to explain why now is a good time to solve this problem, why nobody solved this problem before, and why we shouldn't wait a few more years to tackle this challenge. And another very important thing is to argument why you are the person who is right person to solve this problem. And not only you actually, but also why your team is the team that VC funds should choose as their bet when it comes to this particular issue. You should also prepare, historical financial information in an accessible form, together with metrics that are relevant for venture capitalists, like LTV to CAC, burn multiple. I'm also not going to get into the very details of those metrics now, unless you want me to. There is also a need to prepare financial forecast.
in very much helicopter overview, because
yeah, so basically let me say about the two that I mentioned. So LTV to CAC. LTV is lifetime value of the customer. Basically what it means is like the amount of profit that you will get, gross profit that you will get from a customer during the customer's lifetime. So if you acquire a customer, for example, for a subscription business, and this customer stays with you for 12 months and he pays you $100 per month, the LTV of this customer will be 100 times 12, right? And after that, the customer leaves you, and this is the lifetime value of the customer. And we also have customer acquisition cost, which is how much does it cost you to acquire a customer. And these are all of the costs that you make to acquire a new customer. And this is stuff like salaries of your sales team, your marketing spending. So all that you spend to get this customer. And then you compare the two metrics, right? You compare how much you spent to get the customer and how much money did the customer bring to you. And obviously, the higher the LTV to CAC ratio, the better, because if you spend $1 for every $10 of capital that customer brings you, then it's much better than if you spend $1 and the customer gives you only $2 of money for each dollar.
Is this the most important metrics VCs look in the first place?
It's definitely one of the most important. I wouldn't say it's the top one. It's difficult to really pick. I wouldn't say it's possible to pick a one most important metric, because, for example, it's tempting to say that growth would be most important, right? But if you grow very fast, but you're spending a lot of money to acquire the customers, and your unit economics don't make sense, then this growth is not really healthy. So it's never enough to look at just one of the metrics. But I would say that LTV CAC is definitely in top 5 metrics, sometimes in top 3 maybe.
I think especially now.
Yeah, especially now, exactly. Like 2 years ago, maybe it wasn't the case actually. Investors were willing to fund companies with not very healthy unit economics, and this creates a lot of situations that shouldn't have occurred. But I guess we will talk about it later on.
Yes, exactly. So coming back to the main thread.
Yeah. So let me also mention the second one that I talked about. So burn multiple. It basically compares how much burn, which means how much money the company is spending every month or every year, depending on the time frame you take, to the amount of new ARR, so annual recurring revenue. You can think about it as new revenue that the company gets compared to the money that they burn. And this also is a capital efficiency metric, which became extremely relevant for VCs in the past quarters, I would say, because during these times when we had zero interest rate policies, some VCs, I think, were forgetting about it and funding companies with unhealthy growth, which is unsustainable over the long term. So coming back to the preparation to fundraising, what is also important to prepare is financial forecast. It's not necessary for all of the investors at the very early stages. Obviously, when you don't even have a product, you are at the pre-seed stage, let's say, preparing financial metrics, it's not always necessary because it's so uncertain that it doesn't tell much. But at the later stages, it's definitely very important to prepare it. It's also critical to think about the valuation that you would like to achieve in the round. You don't need to present the concrete number to the investor. Some investors would want to hear the number from you. Some will make you an offer, but it's good to look at the comparable transactions, comparable companies, and see how were they valued, so that you have an understanding of what to expect, and you have some good basis for a discussion with your investor. It's not advisable to start with a valuation which is a few times higher than the market standard, because this won't be received well by the investor. And yeah, at the later stages of the investment process, investors will ask you for some additional documents to be uploaded to the VDR that will be needed for due diligence. But I guess usually investors provide a concrete list of the files and things they need. So I guess there is no need to go in detail here. One maybe general comment here. It's very important to be consistent across documents. Sometimes I've seen situations where I opened the pitch deck and the size of the funding round was $2 million, and then I opened the Excel file and the size of the round there was 3 million, for example. And it really shows the investor that you don't have a very well developed plan for the company, or you are simply not preparing the materials that are of high quality. So I would say that it's very important to keep this consistency across the documents. And maybe it's also important to say what you shouldn't prepare, because sometimes I see materials which really take long hours or days to prepare, but investors don't really need them that frequently, or sometimes never, I would say. So one of the examples is, this long documents in Word, business plans written in Word, which have dozens of pages. I would say that Typically, VCs won't read them because simply they don't have time. We prefer short presentations with only key information there, and the details of the business are then
How
discussed.
short?
How short? I would say that maybe 15 slides to give like a number. It obviously varies by stage. So if your company is at a later stage, you have more information to present. You have some financial metrics, some forecasts, more information about your customers. So I would say that it varies by stage, but in general, 10-15 pages should be enough to convince an investor at least to get a meeting with you or to start. Also, don't prepare unreliable comparisons with competition. There is a meme about this that I really like, and let me show it to you actually. Can you see it?
Yes.
Yeah. So basically, this is it's quite funny for me because this is something that I see quite frequently in the pitch deck, and basically what it shows how ridiculous the comparisons with the competitions are sometimes, and startups are very often this frog watch, which claims to be better than Rolex because it's affordable and it's a frog, and Rolex is not. And really don't prepare comparisons with competition with competition which looks like that, because yeah, you simply lose credibility. I would say it's important to highlight your advantages over competition, obviously, but it's also much appreciated if you actually are aware of your weaknesses and you know where you have to improve. And it's much better than just picking some criteria which are meant to demonstrate that you are better than the competition. So to finish the point about what to not prepare for investors, also I would advise to not prepare unrealistic projections, because as I said earlier, similar to the comparison with competition point, you simply lose credibility. Obviously, it's important to have high ambition and to be able to grow fast, as I mentioned during the beginning of our conversation. But just stay realistic, and don't overdo it. That would be my advice.
What should I do in the process of choosing a VC investor?
Yeah, so
how to choose wisely?
Maybe before I answer this question, it's important to tell how difficult it is to actually get funded. I don't know the statistics about all of the investors, but in general, what I can say is that out of every 1,000 companies that a VC fund looks at, only a few will get funding. So it's really difficult.
Up to 10, up to 20?
No, only a few. I would say less than 10. Less than 10 out of 1,000. Obviously, it varies across the investors, but it's really a very small number. Frequently less than 1% of the companies that we look at.
How to choose wisely a VC partner?
Okay. Yeah. So it's important to think about, first of all, it's important to think about choosing a VC partner in the long term. Getting an investor is sometimes we compare it to marriage, because you will work with the investor very closely for a long period of time, sometimes 5, 7, 8 years. So it's really a long cooperation that you are signing for, and for this reason, it's really important to actually approach this in a very organized way, and to really check the investor. Because if you choose the if you choose the wrong investor, it can really hurt you in the long term. So how to actually choose the investor? First of all, the first thing that I would recommend to do is to check the track record of the investor. And this is really relatively easy to do. You can check the portfolio companies on the website. You can check the previous investments on the website and see whether there were any success stories, whether there are any companies you know. And also it's important to check whether the investor has any competitive companies, because sometimes there are some doubts whether the investor won't meet with you to gain some information about your company and want to invest at the end. The next step
Is
would
it
be
common?
no, it's not that common because it doesn't happen frequently, because as an investor, your reputation is extremely important. If you lose your reputation, you will have very difficult time finding new portfolio companies. I actually don't know any concrete examples about it. I've heard something about some other people, but it's never happened to our portfolio companies when they were fundraising. So it's not that common. Another point of the analysis would be to make reference calls with the portfolio companies. So it's probably only applicable to investors that are already close to signing a term sheet with you. You won't do that at the very early stage of the analysis, but we as investors also talk with customers of potential investment targets, and I think that it's always necessary for the company to talk with portfolio companies of a venture capital fund as well. And the best way to do it is to choose the portfolio companies that you want to talk with, and then ask for direct introduction, so that you can get introduced by a VC to a specific firms that you want to talk to. Those would be most likely firms that have the most similar business model to you, or operate in the similar industry.
And you shouldn't be afraid to ask VC to do it for
No,
you.
absolutely not. Absolutely not. Actually, we are happy to do it, because everyone claims that they have smart money, then work great with portfolio companies. They are so supportive, but actually only when you talk with portfolio companies you can verify it. So I would say that if an investor doesn't want to make an introduction, this should probably
A
be
red
a warning.
light.
Yes, a red light. Maybe if the VC is reluctant at the early stages of the conversation, that's okay. But when you go further in the process and they tell you that they won't do it, then definitely it's a red light. It's also important to look at the size of the fund of a VC. Why is it important? So VCs raise a specific size of a fund from LPs that they invest over the 10 years that I mentioned previously. And it's important to know how much of this fund is still left to be invested, so that you can get a sense of you can get an idea of how much capital a VC could potentially invest in you in your future financing rounds. And this is important because when you raise your next financing round, new investors will expect your previous investors to commit additional capital, because it shows that they still have faith in the company and that they want to increase their shareholding of the company, or at least keep the same shareholding that they had before the new round. And the last point I would say is to check the limited partners of the fund, or to check the structure of the fund. So, for example, we at Warsaw Equity Group are different kind of fund that most venture capital funds, because we don't raise outside money from other investors. So we are not forced to sell the companies within a specified time horizon. We invest the capital of only two private individuals who are our only two limited partners, and we operate like a family office. So we are an evergreen fund which uses proceeds from the exits to make investments. And typically VC would sell the company, make an exit, and then return this capital to investors. And specifically to Poland, it's also relevant with some funds that are backed by public money, because then there are some kind of restrictions when it comes to the investments these funds can make, and sometimes they they have to find a private partner for investment to validate that the investment is a good investment and to also, support the ecosystem. And sometimes what happens is that the fund says that they will invest in you, but they need to find those partners for an investment, and it can take even a few months. And if you are running out of cash, this may be a problem.
Is the list of LPs publicly available? Is it the market practice?
No, it's not publicly available, but it's possible to know whether the fund is backed by some public institution, most commonly, and this is most important. The specific LPs, like the private individuals that contribute to the fund, are not that important. So I would say that the fund will definitely tell you about the structure of the LPs, so that you can know.
And if you ask openly at a later stage of an investment process, who are your LPs? Will a good fund tell you?
They won't tell you all of them for sure, but they should tell you if they are backed by PFR, for example. They should tell you that they are backed by PFR if they are backed by some European.
This is in the case of
funds.
Poland. PFR
Yeah,
is,
exactly.
is a Polish fund of funds.
Yes, they will also tell you that, but they won't tell you the specific, let's say, high net worth individuals or some smaller LPs.
Endowments are.
Yes, exactly.
I'm asking because you said that it's let's say before saying yes, one should get to know that who the LPs are. So it's rather more informal work to do.
Yeah, maybe not all of the LPs, but I would say if there is any big LP which can limit the decisions of the fund, so that would be a good way to put it. Sorry if I wasn't clear. Yeah.
So this is the important thing.
Yeah.
Right. What the VC investment landscape looks like today in the time of inflation rising, or maybe stagflation taking ground with all the recent calamities regarding SVB and Credit Suisse and the like. And we were accustomed in the era of low interest rates to what I call serial entrepreneurship. And I make it a joke because I mean by serial entrepreneurship, we get from one series to another until, let's say, we are too big not to be financed or too big to fail. Which is coming back to what you mentioned before, that one of the most important metrics today is what we are paying to acquire a new customer and what a new customer will bring to us. Because in my very view, the industry has lost this point of view. Maybe not the whole industry. I don't want to make oversimplifications, but something like a year ago, where we were on the peak of the tide, and the money was still cheap. I would say that the industry was doing serial entrepreneurship at its best, without looking at fundamentals. What is your opinion on that?
Yeah, it's definitely true. It was very easy to get funding. Let's say in 2020 or 2021, the valuations were also extremely high. There was very short time between contacting an investor and receiving funding. Sometimes it took just a few weeks, and it seems that it's good for startups, but sometimes it's not that good because they also don't have enough time to get to know the investor. So I think that actually the situation from 2020 and 2021 was totally unusual, and I don't think that we are getting back there anytime soon. Some founders think that we are now at the bottom of the valuations, and that they will wait a year or 2 years, and that valuations will go back to the levels from 2 years ago. But I actually think that's not the case. Let's maybe also discuss how actually
Will we ever
valuations.
get there?
I think that's maybe, but it's definitely not normal what's happened during those years. So it's a mistake to think that this is something that that is normal and will come back soon. Sometimes I wouldn't say that it will never happen, but definitely, at least in my opinion, not within the next few years. Let me show you to our listeners how the valuations look like at the moment, and how did they look during the peak 2 years we talked about. So what you see here is an index of valuations. It shows a median enterprise value to revenue multiple. It's basically a way to compare the valuation across companies, and this is one of the most common.
Could you explain it a little bit further to some of our audience who don't, operate the jargon?
Sure. So enterprise value to revenue multiple basically tells you in simple words what multiple of your revenue is your company worth. So if you have $1 million in revenue, and you estimate that the relevant valuation multiple for the comparable group of companies is 10x. To determine the value of your company, you multiply this multiple, so 10x by 1 million of revenue, and you derive the value of your company, which is $10 million. This is an example of how this is used in practice. And the chart here shows probably the most commonly used benchmark for valuation. This is Bessemer Venture Partners Cloud Index. It shows median EV revenue multiple for publicly listed SaaS companies in the US. And what you can see here is that the index was at the level of, let's say, 6 times revenue from 2014 up to 2017 or 18. And then we had those crazy 2 years, 2020 and 2021, where the index reached 18x. And it's a huge difference. The reason for this was obviously like the zero interest rate policy, which made capital very cheap. And now we are back to the level of 6 times revenue. So from looking at this chart, it seems that it's relatively cheap right now, doesn't it?
It looks like.
Yeah, but we were thinking a lot about it at Warsaw Equity Group, and actually it's not that cheap as it may seem from this chart. Why? When you look at the time frame of this chart, it includes only years after 2014, right? And this implies that it doesn't even have the data about the last financial crisis. So we are looking at ways to see whether this is really the bottom, or whether the valuations can drop even further. So it wasn't possible to go back in time using this particular index, because this index was constructed at the end of 2014, I think. So we looked at a wider group of growth companies which exhibit in general similar characteristics to the SaaS companies. Obviously, it's a different group of companies, but the valuations of those companies are very correlated to the valuations of SaaS companies, which also exhibit growth characteristics. And what we found is that there is still a lot of potential for valuations to drop. So looking at this chart, you see that it includes data from 2007 up until today. And what we've seen on the previous chart was only the right side of this chart. So from 2014 to 2022. And actually, when you see to the left side of this chart, you see that there is still a lot room for valuations to drop. You see that actually this one important comment. This chart shows a different valuation multiple. It's price earnings, but as I said, it's correlated to the previous one. So it's not one-to-one comparison, but rather like we use it to get a sense of whether the valuations can still drop. And you see that the valuations now are at 50 times price to earnings, but during the financial crisis, they dropped below 12 times price to earnings. I'm talking about growth companies, so the blue line that you see on the chart. And when you look only at the chart that I showed previously, you may get a false sense that actually now it's an amazing time to buy and it has never been cheaper. Actually, I think it's not the case. I don't know if the valuations will drop even further in the next year or not. But what I know is that you shouldn't have a sense that the valuations are now super low and they can't go and that they can drop. I think that if a recession occurs, there is still plenty of room for them to decrease.
Do you think that a kind of recession might occur within the next months? It's just like a side question, because to me there is just a lot of talk about it.
Actually, this is also something that we monitor very closely because it has a huge impact on valuations. So, for example, what we looked at is difference between yield of long-term bonds and short-term bonds. And maybe to just quickly explain what is yield of the bond for some of our listeners who are not familiar with it. Yield basically is a figure that shows how much return you get from a bond. So the higher the yield, the more return you will get from a bond. And in general, the return of the bond, the yield of the bond is inversely related to the price of the bond. So the higher the price, the lower the yield. And typically, bonds with longer maturities. So, for example, bonds with 10 years time to maturity compared to bonds that have, for example, 2 years to maturity, will have higher yields. This is because investors look for compensation of risk, which is associated with investing in those longer maturities. There's like a long list of risk, but most important are interest rate risk. So the risk that interest rates will rise over the long term and that these bonds that you purchased will become relatively less attractive to the new bonds that are issued on the market. And also there is inflation risk, which basically is meant to, which like says, let me maybe phrase it differently. So inflation risk is a risk that the coupon payments of the bond will be less valuable because the inflation will rise. And when you purchase bonds that are longer time, you seek compensation for those risks. And this is why the yield is higher on longer maturities bonds.
Just an example, a Silicon Valley bank defaulted because of over investing in the long-term bonds.
Exactly. And then when rates went up, the value of the bonds fell, and
Exactly.
this was basically the main reason of the collapse. Exactly. So typically, as I said, what you see is that the yield curve is upward sloping. So the higher the longer the maturity of the bond, the higher the yield. And what we see now is that bonds with shorter maturities have higher yield than bonds with longer maturities. And
which is anomaly.
This is anomaly. This doesn't happen often. And why is it important? And what maybe first, why did it happen? So It happens when investors expect interest rates to fall in the medium term and want to lock in higher rates. So when they want to lock in higher rates, they look for bonds that have longer maturities, and they purchase those bonds. When they purchase those bonds, they increase the price of bonds with longer maturities. And as I said earlier, when they increase the price of those bonds, the yield of those bonds drops. So the yield of the bonds with longer maturities dropped, causing the inversion of the yield curve. And now, why is it important, you may ask? We are talking about this technical stuff here. Why should anyone care? There is a very good reason to care about it, because
looks like recession is not coming.
It looks like recession is coming. So basically, the yield curve inversion is predicting is a recession predictor. When you look at the past recessions, the vast majority of them was preceded by the inversion of the yield curve, and this is where we are at the moment. So this is a sign that the recession might occur. It's not an ideal indicator, obviously. There were some cases where the yield curve inverted, but the recession didn't happen. But in general, it's a quite good predictor, and mostly it's predicting the recession. It's not giving many false signals, actually.
How did it all change? The policy of VC funds in what to invest in. So Unicorn, as we all know, is a company that is valued at least $1 billion. And there are always discussion if one is a unicorn or not, and how to assess it, how to value. But recently I've come across another animal comparison, which is zebra. And zebra is not necessarily a unicorn, but it's a solid tech company with grounded revenue streams and with strong fundamentals in what we have discussed, which means acquisition of a customer and return on a customer. So a company that is pinned down to sound, good old sound economic principles. So obviously VCs are kind of species that have to take risks, because the ratio of companies that create returns is very small. I recommend a brilliant book on the issue called The Power Law, which is a short history of VC industry, but the power law, or the Pareto principle taken to extremes, is probably the key thread of the book. So this is on one hand obvious. On the other hand, we, right before all these valuations went down, we were at the peak of what I joke was serial entrepreneurship economy. So is it possible now that VCs will move towards less risky stuff, even though the whole concept of VC is to play very ambitious, play very risky?
It's like, I would say that it's always a question of risk versus reward for VCs. So like typically VCs, as we mentioned before, look for very high returns, but are also willing to accept a very high level of risk. So you ask whether VCs will now be more cautious in the investments.
Or more focused on zebras than unicorns?
I think some of them actually. We at Warsaw Equity Group, I would say that we are mostly focused on zebras. I mean, we don't mind unicorns, of course, but we've never looked at the VC game. So this chasing only the higher valuations on paper and raising another round within 18 months from the previous round. We always try to look at the very fundamentals of the business. So I wouldn't say that the majority of VCs will change their investment policies. I think they will still look for unicorns, and they still will be willing to accept very high levels of risk. But I think that they will pay more attention to unit economics that we discussed previously. So LTV to CAC, they already started monitoring those metrics closer. And I think that what will change is that companies that are burning a lot of money and have unhealthy unit economics will have difficulties with getting funded. On the other hand, companies which have extremely good unit economics and high growth potential, and they check all of the boxes for a VC fund, they will still be able to raise funding, and they will receive high valuations, and there will be even competition from VCs to invest in them.
Given the current hype over ChatGPT, is it reflected in the VC strategies today, and how will large language models, generative AI, or rather the whole ecosystem, because you need tremendous money to invest to create something which would be barely a competitor to OpenAI, but a whole ecosystem will probably emerge of small companies using this kind of solutions. Is it now so hyped in the VC community as well, or not that much?
Yeah, there is a lot of hype, definitely. And I think that this technology is so revolutionary that it's to some part justified, I would say. But what I've observed is that VC investments preferences also follow a hype cycle, like the Gartner hype cycle that you may be familiar with. Basically, at the beginning, when the technology is introduced, there is a very rapid increase in the hype for this technology. Then there is a peak of expectations, which is very high. And then everyone has super high expectations about the potential of the technology, about the problems that the technology will solve. But then it gets verified. Some people get impatient. They think that this technology is not so revolutionary at the end, and the hype falls. And there is like the minimum of the hype at some point in time. And after that, there is like a very steady but more flat growth of the hype. So I think that where we are today with generative AI is we are basically at the peak. So everyone talks about it, everyone knows about it. There is a huge number of users of ChatGPT. Just to give you an example, how does it compare to other technologies? Because I think that
this is the fastest growing technology.
Yes, this is incredible, actually. So for Facebook, it took 10 months to get 1 million users. For Spotify, it took 5 months to get 1 million users. For Instagram, 2.5. Do you know how much time did it take for ChatGPT to reach 1 million users? 5 days.
Really?
Yes, this is incredible. I can show you the chart later, or maybe we can show it to our viewers when you.
I had in my mind a figure of 2 months to reach 1 million users.
We can show the chart later when
Sure.
we'll edit the video, I think. But yeah, the pace of development is very, very fast, and it's really unprecedented. So I think that everyone, even from a user perspective, you can see how fast do those tools improve. We had GPT 3.5, which was released a few months ago, and recently GPT-4 was released, and it already has a number of new incredible new functionalities added to it, and it only took just a few months to be released. And I think, and it was trained even earlier, right? So when you look at the pace of the improvement of the technology, it's really something that is unprecedented, and it's incredible.
I think it has its limits. I
Yeah, obviously.
my article on LinkedIn that I wrote this very week, that why some Altman declared, I don't know, a couple of days ago, that ChatGPT 5, and we don't count numbers here. I just mean, let's say, new capabilities of the tool is not to happen anytime soon. Because the costs of solely energy to train slightly bigger model or slightly more fine-tuned model grows exponentially towards the capabilities of a model. So,
Yes.
for instance, to train ChatGPT 3, it took, these are estimates by the Economist, it took $4.5 million US. To train ChatGPT 4, it took $100 million US.
This is crazy, right? So it's
just
difficult
electricity bill.
It's difficult to imagine a company in Central Eastern Europe that would be able to compete with that, right?
Impossible. So that's also impossible to. And I remember just comments from the beginning of this year of 2023 that teams of independent researchers may jeopardize the position of OpenAI or DeepMind or similar organizations backed by billions of dollars from Microsoft, from Google. No, it's these are huge data centers. These are enormous infrastructures, and these are enormous electricity bills. Last but not least.
Yeah, exactly. So actually, what is extremely important now is to develop better hardware, better chips for those applications. Chips that will be cheaper and will be more accessible to a wider public. Because at the moment, there are only a few companies in the world who can spend enough money to be able to train models comparable to ChatGPT. To GPT-3 and GPT-4.
Do you think it's possible for European business to design? I don't mean to produce, because this is a whole different story, but to design AI chips. And is it a good field of investment for European VCs?
In terms of field of investment, I think it's actually extremely interesting, because like every application that will be implemented in generative AI will have to use some kind of hardware, right? So you don't have to make a bet on a specific model or on a specific end-to-end application. But if you choose like the right company that will win this race of chips, then you will enter a huge market, because this is something that like supports all of the end user applications. And regarding European companies, I think there is potential for them, but on the other hand, you have companies like basically NVIDIA is leading the race, right? So it's definitely a leader now. They introduced, I think, 2 months ago, or this year, chips which are meant for AI processing, which are for very specific use cases. Previously, they had the chip NVIDIA A100s, but now they introduced chips which are meant for very specific use cases. So for processing, for example, images, other are meant to process videos, other are meant to process audio. So it's incredible that the specialization goes not only to the chips for AI, but also chips for specific AI use cases. And what we had during the previous years was basically training of models on GPUs, so graphical cards. And now we have this dedicated chips. Coming back to your question, I think that's Europe can compete, but it will be difficult because still the funding is available funding is much higher in the US. There is also, I think, more talent in the US, but it doesn't mean that there is no segment in this chip race that Europe can win. Because as I said earlier, there's this specialization of chips for specific use cases. So I think that there is probably some part of the pie that can be won by Europe.
The last question, how does Europe look like in the AI development from a VC perspective in comparison to the US, in comparison to China?
Yeah, so definitely, I would say that at least from my perspective, US is leading the race. Let's simply take the ChatGPT, right? It's based in the US and it's something that everyone talks about, and we don't have a competitor in Europe. That's I know. I don't know if you know any competitor.
No.
Which makes sense from Europe, right? So I think that definitely US is leading the race. Just to give an example of the differences in terms of funding available for startups in AI space. So VC funding for AI startups in USA, according to OECD, in 2021 was $110 billion, and in Europe it was 13. So you can see that the difference is really, really high. Also, comparing this to China, China had 50 billion. So China is roughly half of the US and we are about 10%. So there are really high differences. I hope that we will have some success stories in EU, but given the funding gap, it might be difficult to compete with US. So I think that's probably at least looking at the current situation, US will be leading the race, but I think that Europe will find some applications that we will be leading. Maybe something related to higher data privacy or something which is more like regulated. And I think that this is where we actually have an advantage.
Right. Jan, thank you very much for this possibility to talk to you. This was a very informative, very valuable conversation with a lot of fascinating data and very, very practical data, you know, to comprehend what is going on right now. And also, I guess, very practical for this part of our audience who are founders looking for a potential VC backing. Though, as you said, and as I know, it is difficult to get funded, but encouraging our funders to contact you.
Thanks a lot, Maciej. It was a pleasure.
Thank you, and I hope it wasn't our last conversation.
I hope so.
Thank you so much for listening to Sherpa Search on Tech. If you have enjoyed the show, please subscribe to our show wherever you listen. Thanks again. The Sherpa Search on Tech podcast is a production of Sherpa Search, an executive search firm specializing in the tech industry, helping hire the right people for expert and managerial positions, and advising how to build and develop long-lasting, high-performing IT teams. If you would like to learn more, reach out to us at maciej.szczerba@sherpasearch.tech or visit our website sherpasearch.tech. See you next time.